Welcome to Euromoney. Gary Gensler and the agency he runs, the Commodity Futures Trading Commission, is set to become one of the most powerful financial markets regulators in the world. The Dodd Frank bill, signed into law in the US in July, gives them a clear mandate to rein in the $615 trillion over-the-counter derivatives markets. Now, this is a market that allows companies and financial institutions to hedge their financial markets risk, but it's been accused of helping cause the financial crisis. I recently spoke with Gensler to discuss the CFTC's new role in regulating the OTC derivatives market. Here's what he had to say.
To lower risk to the public and to increase transparency. Transparency both lowers risk, but it also leads to greater market efficiency. It tends to narrow bid-offer spreads. That's not what Wall Street likes, but it tends to help all the markets, the public investors, and of course the corporate hedgers. So I think it's about increased transparency and lowering broad risk. So in my conversations with Ram and Emmanuel and Tim and Larry at that time, now they have big jobs, and the president-elect, it was about the CFTC's role in bringing reform to the over-the-counter derivatives market. So this was the lane that this agency swims in, has great expertise since, frankly, all the way back to the 1930s. And then I could hopefully bring my background from Wall Street and my background from Treasury, my background from working with Paul Sarbanes, and to this. This statute, it's only 14 days old, but as you rightfully say, there's a number of specifics on it. First, it tells us that we have to, by statute, work with international regulators to harmonize. There's other provisions that say that for the trading, the exchanges, the swap execution facilities, the swap data repositories, the clearinghouses, that we can recognize comparable and consistent regulatory regimes overseas. That we can do what's called mutual recognition. With regard to the data repositories, that we can have that by rule, share that information, and make sure that it's available with overseas regulators, which I think is a good thing, that it needs to be.
And will be challenging as well, getting Europe and US to share.
Well, it is, but Congress has addressed that, and I think we need to be committed to that sharing of information. Risk doesn't just go away, but let me note that clearinghouses have existed in this country since the 1890s. They've survived 2 world wars, the Great Depression, this crisis of 2008. Banks fail every 3 to 5 to 7 years. There's a major bank that goes. So it's really a matter of which is a better approach to mitigating risk. And clearinghouses are far better, and they've proven out over 100 years to be better. Why? They're not in other businesses. They're not in lending. They're not in proprietary trading, right? 2, they have to, by rule, value all their transactions on a daily basis and then collect a performance bond we call margin. 3, they also get an initial posting or performance bond. So they have this initial margin and the variation margin, and they value everything every day. And then they have this mutual guarantee fund and other risk mitigations. No one should assume there's not risk. That's why they need to be regulated. They need to be very well regulated, and up to international standards. And the statute is very strong in that we can adopt new rules as there's evolving international standards working, whether it's with IOSCO, with our counterparts in Europe and in Asia, to evolve the rules. Let me just say one thing about swap execution facilities. A question that market participants have come in and said, well, what does this provision mean in here? There's a provision defining it that it has to have multi-parties able to accept offers and bids
Yes.
from multiple parties.
Yeah.
I go, well, that seems pretty straightforward.